Hey guys, Professor Dalton here, doing a proper intro to financial accounting video. This is the first in the series. If you've already watched my tricks on how to remember the rules of debit and credit, a lot of this is going to be the same thing, but I wanted to kind of give a proper intro to the course of financial accounting and really kind of hit some of the terms that you might not have had if you haven't been in an accounting class yet. So accounting is the language of business. It is how businesses speak. It's how they communicate. And in particular, is how they communicate their results. Accounting is the act of identifying, recording, and communicating business results. And because accountants are the communicators of this information, ethics really are key to an accountant's profession. Ethics are paramount. Accountants are expected to be ethical. They're expected to communicate business results reliably. So ethics are, and have of course become since all of those really weird and fun frauds of the late 90s, early 2000s, ethics have really kind of become key in the study of accounting. And speaking of Sarbanes-Oxley, Congress passed Sarbanes-Oxley to help curb financial abuses that companies have been engaging in. So financial accounting is governed by GAAP, the generally accepted accounting principles. This is what guides accountants. This is the rule book, the Bible, all in one. GAAP is a governing body. They ensure that information is accurate, reliable, and comparable. That is to say that, again, when we are interpreting the communications of a business, when they're telling us how well they're doing, they're trying to entice investors. If I'm an investor and I'm looking at two different companies, I want to be able to compare that information in order to make a good comparison, right? I'll make a good decision over which company to invest in. GAAP exists to help investors, help outside creditors decide the credit worthiness, if you will, of a company. So there's a few principles we need to get to. The measurement or cost principle basically says that the actual cost is how we are measuring. That is to say that we never mark up values for things like collectibles. We are always marking assets acquired at their actual real acquisition cost, and that's the only thing we're going to call as an asset. The expense recognition principle, or as I'll mostly call it, the matching principle, basically says that we're going to match revenues with expenses. And if you kind of think about our accounting system, the way it works is when we, let's say, spend an asset, cash, to acquire another asset, gasoline. Let's say I am a lawn care business. I mow lawns on the weekends. I need to acquire equipment. I need to acquire supplies. Those supplies are going to help me in my business. So when I purchase fuel, when I purchase gas to go in the lawnmower, I'm exchanging an asset for an asset. I possess that asset until I use it. When I use it, it becomes an expense. So the matching principle, along with the revenue recognition principle, basically what these guys tell me is that I'm going to recognize revenue when I complete the service because I'm going to incur the expense when I complete the service. So they both happen at the same time. Our revenues are matched with our expenses. We recognize the use of the gas when it's no longer an asset, it's an expense. We recognize the revenue when we do the service, trusting that we're going to get paid. The revenue recognition principle tells us that we recognize revenue when it's earned. And this is an interesting idea because what it's telling us is that we can recognize when we earn revenue, not necessarily when we receive revenue. I can perform a service for someone, I can mow their lawn, let's say, and I'll bill them later. I'll just send them a bill and they can pay me later. It's fine. But I've earned revenue today. And what's interesting, going back to the matching expense, and we'll get into the matching principle, we'll get into all this, a little bit later. We are matching the two. I recognize the use of the gas and I match that with the revenue of the lawn mowing service. They match. I recognize revenue even if I don't get the cash yet when I perform the service. Full disclosure principle basically just says that we are disclosing everything that is relevant to investors in order to make a decision. A few assumptions to look at as well. The going concern assumption basically means that we are anticipating this business will remain in business for the foreseeable future, which is really just in the next coming year. Business entity assumption states that the business is a separate legal entity from even its owners and its investors. Monetary unit assumption just says that we are going to communicate our results in US dollars. The time period assumption states that we are going to present our data in definable time periods that is understandable by an investor, and we usually do this by months, quarters, and years. Makes sense, right? A few more items that's mostly terminology: proprietorship, partnership, and corporation for business types. A proprietorship is typically a sole proprietorship, one owner, that is, again, just kind of a small business person, maybe a hobbyist or something like that. You can even get accountants, CPA firms that are a sole proprietorship. Partnership would be two or more. You're looking mostly at like doctor's offices and, of course, some accounting firms, law firms, things like that. Corporations, of course, we all know about, and that's really what the focus is going to be for our accounting class and really for most accounting classes out there. Corporations are also the only entity that is subject to GAAP, generally accepted accounting principles. If you're not a publicly traded company, you don't have to worry about GAAP at all. All right, and now to the stuff that's really going to be kind of a repeat, but I wanted to go over the accounting equation again in this one just to kind of keep everything flowing along at a normal pace, normally with what an accounting class would go with. My goal here is for you guys to be able to watch this after your accounting class and maybe get a different perspective on it, as well as be able to hear a lecture again, pause, rewind, obviously all the great things that we can do on video and the internet, right? So my accounting equation, this is the number one thing that you'll be like, this will be it. You'll refer to this for like ever and ever in your accounting classes anyway. Assets equals liabilities plus equity. And there's a reason we state things this way. Assets equals liabilities plus equity. Recognize it as just a normal algebraic equation. We could say liabilities equals equity minus assets, right? That works. We can swap this around, right? Several different ways. Basically what this equation is telling us, though, is that everything we have, and remember, this is a business, all right? This isn't a person. As a business, everything we have, we owe to somebody, right? A business didn't just create itself and create its own money and start buying things, right? People had to give it money. Everything the business has as an asset, I owe to someone else. Assets are my economic resources. Liabilities and equities are my claims to those resources. Liabilities are claims to my resources by outsiders. So I'm looking at bankers, lenders, creditors, those, outside of the company kind of people. Equity is going to be my internally generated funds. My stockholders, because they're technically owners of the business, right? As well as any funds that I have generated as a business and retained. And we'll call that retained earnings, but we'll get to that. But remember, in business, everything the business has, they owe to somebody, either outside creditors or inside supporters, let's say, investors. And recognize that because assets equals liabilities plus equity, we are always affecting, let's say, at least two things in every transaction. Every time a transaction occurs, we have to hit two things, if you will. And we'll talk about this in a little bit, but one thing has to be debited, one thing has to be credited. And it can be more than one thing on either side, but they still have to both exist because, again, as this equation shows us, both sides have to balance. Assets have to equal liabilities plus equities. If we do something to one side of the equation, let's say, acquire an asset, the other side of the equation also goes up. So let's say somebody lets me have $5 worth of gasoline. I acquire $5 worth of an asset, gasoline. They say, pay me $5 next week. I've acquired a liability of accounts payable of $5. Both sides of the equation have increased. So again, recognize, realize, keep it in mind. Every time we engage in a transaction, two accounts, at least two accounts, will always be affected. Some examples of assets. Again, assets are economic resources that will provide a future benefit to the company. Cash, number one, that's the very first thing you should think of when you think of an asset. Accounts receivable, someone owing me money, that's an asset. In business, it's just as good as cash, right? Notes receivable, we'll look at that a little bit later, but it's a more formal version of someone owing me money. Land, building, equipment, furniture, fixtures, everything that the business has to be a business and to function as a business is an asset. Liabilities, again, is something that we owe to an outside or a third-party entity. Examples of this would be accounts payable. That's probably your flagship liability, if you will. Accounts payable is when we owe money to someone else for a good or service that has been delivered. When a truck comes up with inventory, the guy hops out of the truck. He doesn't say, all right, there's 200 DVD players back here. Give me, $2,000, right? He gives you a bill, or the company sends you a bill, and you pay that bill later. That's an accounts payable. We've received the goods, we received the bill. It is a liability because we owe somebody something. We owe it to an outsider. Notes payable, again, a more formal version of us owing somebody something. Accrued liabilities we'll look at a little bit later, but it's basically a build-up of something that we owe to someone else. Think about withholdings from an employee's pay. We'll accrue those in a liability so that we can pay taxes or insurance or whatever later on. Stockholders or owner's equity is the owner's claims to assets. And again, remember my accounting equation. I've got everything the business has equals everything that the business owes to everyone. Think about it this way. My liabilities are my outside creditors, my bank. Let's just say it's my bank. If everything I have equals everything I owe to either the bank or to my owners, what's the difference in the two, right? The difference is the stockholders' equity. To kind of put it into these terms, it's what I keep, right? If I've got all these things, let's say I've got $200 worth of assets, but I borrowed $150 to get those assets, my claim to those assets are $50, right? What I have, I owe to somebody. Some examples of stockholders' equity is common stock, retained earnings, dividends, revenues, and expenses. And we'll see these five guys as really the five that we'll always see. Let's look at the T account for a little bit and just kind of see how this thing works. The T account helps us analyze transactions and helps us determine an ending balance for an account. But what I want to look at now is how a T account, well, just how an account functions under the rules of debit and credit. You'll see we've got an account name, always at the top. On the left side is the debit side. The left side is always the debit side. The right side is the credit side. The right side is always the credit side. It doesn't matter what kind of an account you have, if it's an asset, if it's a liability, or if it's an equity. Debit side is left side. Credit side is right side. Now remember, I told you there's a reason the accounting equation is written assets equals liabilities plus equities, right? There's a reason. Debits are on the left, credits are on the right. And what we're looking at when we're looking at debits and credits, what we're kind of talking about here, we're talking about increases and decreases, and what increases an account and what decreases an account. An account is going to increase or decrease with a debit or credit. It depends on the type of account. Debits, like credits, are neither good nor bad. It doesn't really dictate in of itself the word an inherent plus or minus. Again, it really depends on the account type, what we're debiting, what we're crediting, as to whether or not that means an increase or a decrease in that account. I know it sounds confusing, but bear with me. It gets a lot easier. So here's my rules of debit and credit. Again, the account type dictates what the increase and what the decrease side will be. The other side decreases the account. So again, remember when I said there's a reason we say assets equals liabilities plus equities. Any asset account, all asset accounts, increase with a debit entry. And again, that's on the left side. Assets on the left side of the equation, debits on the left side of the T account, assets increase with a debit entry. Assets equals liabilities plus equities. Liabilities plus equities are on the right side of the equal sign. Well, look at there. They increase with the right side thing, the credit side thing, right? They decrease with a debit. Now again, this is a general rule because if you'll remember, under equities, we had some things that were anti-equity, like expenses. Expenses isn't going to result in a net gain for me, right? It can't. So there's some nuancy weirdness things that we have to look at under the equities, but in general, this rule holds. Assets equals liabilities plus equities. Assets increase with a debit entry. Debits are on the left. Liabilities and equities increase with a credit entry. Credits are on the right. In general, this holds, but we do have some nuances we need to look into. Again, talking about equity, how do the rules affect equity? Well, again, anytime we issue common stock, anytime we retain earnings, anytime we earn revenue, we're increasing the owner's claim to assets. When we earn, let's say, revenue, we get paid in cash. Assets goes up, revenue goes up, right? Expenses is an anti-revenue. Dividends is an anti-retained earnings. Dividends, by the way, is what my owner takes out as, let's say, a paycheck. When my owner decides he needs some money, he writes himself a check, and it's called a dividend. Companies do this with our stockholders. When Ford declares a dividend, they give their stockholders a cut of the profits. That's what dividends are. They're the owner's paychecks. But again, these things work to reduce the equity that a company has built up. So those rules of debit and credit that we looked at a moment ago don't quite apply to equity, except that we have to remember expenses and dividends reverse what revenues and retained earnings mean. So my equity accounts in T account form, again, expenses and dividends work to reduce equity. So they have a normal debit balance. And I haven't really talked about normal balances yet, so kind of keep that word bouncing around a little bit. Expenses and dividends decrease with a debit entry, and they have a debit balance because we're always going to be decreasing my equity when I pay an expense, right? I'm always going to be debiting an expense. Expenses are always taking away from my retained earnings, my revenues. Expenses are a negative to equity. Dividends are a negative to equity. Common stock revenues and retained earnings are a positive to equity. So I have to remember that, again, while a credit increases my equity accounts in general, I have these anti-equity accounts, if you will, expenses and dividends, that I have to debit to show that they are being removed from equity. So here are my complete rules of debit and credit, and it's a lot to memorize. Luckily, we don't have to. But if you'll notice again, I've expanded equity. Assets equals liabilities plus equity, but I've expanded the equity section to show common stock, retained earnings, revenues, expenses, and dividends. Notice how the plus and minus, the increase and decrease, notice how they work. Assets increase with a debit entry. Expenses increase with a debit entry. Dividends increase with a debit entry. Liabilities increase with a credit entry. Common stock, retained earnings, revenues, they all increase with a credit entry. How can we remember all these, though? As long as we remember what an account's normal balance should be, we can remember what increases the account. If you can remember what increases the account, well, then you can remember what decreases the account, right? You only have two choices. So this is how I remember it. Debit side, credit side on our T account. Assets, expenses, dividends have a normal debit balance and they increase with a debit entry. On our credit side, we have liabilities, retained earnings, revenues, and common stock. Again, these accounts increase with a credit entry. They have a normal credit balance. But again, we don't want to remember all this mess, right? We don't have to memorize this. We've got things to do. Busy people, let's make up a weird, wacky sentence. This is what I came up with when I was an undergrad, and it served me well for all 4 years. And again, I really enjoy passing this down to you guys. After eating dinner, let's read raunchy comics. I was 18, 19 when I came up with this. I had recently started collecting comic books. I thought it was kind of funny, and I've used it as a pickup line a time or two, and it doesn't work at all, so I wouldn't recommend it for that. But for remembering an accounting equation, for remembering the basic rules of accounting, the rules of debit and credit, this is your go-to. This will get you through. Let's look at some financial statements real quick just to kind of close off this chapter. The 4 financial statements that we're going to look at and their purpose. The income statement. The income statement describes the company's revenues and expenses along with the resulting net income or net loss. The income statement is summarizing a period of time, so we'll see an income statement published, let's say, for the month ending, because it's going to tell me the entire month's worth of revenues and expenses and total it down to a net income. Now I'm going to need this net income number in order to complete my statement of owner's equity. My net income, you'll remember, is everything left over from my operation, my income statement, my revenues and my expenses. The difference in the two, hopefully it's positive, gets added to what my owner's claim to business is. It gets added to the owner's equity. So I have to complete the income statement first. I can then use my net income to complete the statement of owner's equity. The statement of owner's equity again summarizes changes and explains the changes in net income over that period of time, which again is typically a month. Basically what I'm doing here is I'm getting my net income, hopefully, by analyzing my revenues and expenses. I'm adding that net income to my owner's equity. I'm updating my owner's equity, and then I can do my balance sheet. My balance sheet very literally is just for that day only, and it very literally shows me my assets equals liabilities plus equities. It lists all of my assets, gives me a total for my assets. It lists all of my liabilities and equities, gives me a total for my liabilities and equities, and they need to match. They need to balance. If they don't balance, we did something wrong. Something's off somewhere. Because if you remember, I'm always entering something twice. There's always 2 entries for every transaction. One thing gets debited, one thing gets credited. More than 2 things could happen during a transaction. For now, we're only going to have 2. But we are always going to balance that equation. If assets always equals liabilities plus equities, my balance sheet will always balance. But again, remember, I have to do my income statement first to get net income. I can add that to my statement of owner's equity to get the total in owner's equity. I can update my balance sheet to show changes. Actually, it's not even changes, sorry. It is a snapshot of that very day at that very moment in time. The balance sheet does not summarize any time period. So when you see a date on a balance sheet, it'll be for that day only. The statement of cash flows doesn't rely on any of these other reports to get finished, but you can tie cash to the balance sheet, and really you kind of need to have your cash balance updated before you do your statement of cash flows. But the statement of cash flows shows my cash inflows and cash outflows over a period of time, and they typically will summarize it with the type of function that generated the cash flow as well. Because remember, companies don't always only produce whatever it is they're known for. Here's an example of an income statement. Again, we've got our revenues, our expenses, giving us net income of $4,400. I have to use that $4,400 in order to make my statement of owner's equity complete. I started with $30,000. I added $4,400. I took out $200, so I end up with $34,200. That $34,200 is needed to complete the equity section of the balance sheet. And again, if you'll notice at the bottom, total assets equal, I believe it says 40,400. Total liabilities and equities also equals 40,400. They should always balance. If they don't balance, stop. You've done something wrong. You can always check your work in accounting. Any homework question you do, you can do your financial statements and make sure that everything balances and everything works out. If it doesn't, you did something wrong. Don't hit submit on a test. Don't hit submit on homework that's graded without checking your balances first. Debits will always equal credits. Assets will always equal liabilities plus equities. You can check your work. Quick section, let's see, this is the bottom of our balance sheet again, and the statement of cash flows, again, just kind of showing that our cash balance at the end of this period, December 31, is going to equal the cash balance on December 31. But again, keep in mind that the balance sheet is only a snapshot of that moment in time. Well, thanks a lot for joining me. Next time, we're going to look at journalizing and posting transactions. Thanks so much for watching. I hope you enjoyed, and if you did, hit that like button and please subscribe. It would help me out a lot, and it'll let you know when I post a new video. Thanks a lot. See you next time.